Broadcom Inc. ticker symbol AVGO, currently trading at $181.53 a share. Year to date, this stock has been on an absolute tear, up almost 67%. What we're going to be doing today is looking at my automated stock valuation spreadsheet to see if Broadcom is a buy or a sell using discounted free cash flow model, comparable company model, dividend discount model, and of course the Ben Graham formula for intrinsic value. So let's quickly get back on to the chart here. So as I said, Broadcom has had an excellent year, up 67%. If we go over the last year, 105%, and over the last 5 years, up almost 500%. If we look at from the bottom of the pandemic crash, it was trading about $19 a share and is up almost 800%. Obviously, if I do compare to the S&P 500 over that same time period, or in fact any time period, it is easily beating the market, even up to the last 5 days the market's beating it, but that's not really it. Yeah, month, 6 months, any horizon, Broadcom has easily beat the market. Also pays a nice little dividend of 1.17%. We'll be talking about that right now. So if I go to my automated stock valuation spreadsheet and type in ticker AVGO, this will load up all the latest company financial data so we can have a deeper look. Price $181 a share, market cap $850 billion, a PE of 150, which no surprises there, is slightly higher than the market average of 29. In fact, even higher than the 70s of the 2009 and 8 crashes. But this is a growth stock, so let's have more of a look. Earnings per share, $1.15. Beta, interestingly, of 0.92, meaning it's slightly less volatile than the market. Maybe historically it has, although I suppose if it's always just going up, then that is not very volatile. Shares, 4.7 billion, and analysts do say it is a buy at $195. Dividend yield 1.16%. Ex-dividend date is 19th of December, so buy your shares before then if you want to get paid the dividend. That's $2.11 per share dividend. Total dividend about 10 billion. Payout ratio surprisingly high. Maybe the trailing 12 months you can see we've got, well, have a look at this, interesting, but yeah, very, very high dividend in terms of what they are paying out. Net income 190%, whereas free cash flow a lot safer, 52%. So let's have a look at the revenues. All-time high, surprisingly, trailing 12 months, 40.82 billion. You can see this is going back to 2018, and revenue has been consistently going up every single year, and in fact is growing sort of at a more exponential rate over the last few years. Net income, what are they doing with that revenue in terms of profit? All over the place, really. Trailing 12 months, 5.1 billion, down from its all-time highs of the prior year of 14 billion. So hopefully we can have a deeper look and see why. Free cash flow, though, it is generating a lot of free cash flow, 18.66 billion, beating the prior year of 17. Now, obviously, they are using this to pay things like dividends, and as we've seen, it is safe in terms of free cash flow. If we have a look at operating income versus capex, capital expenditures surprisingly pretty low. It looks like it hasn't changed. Obviously, on this scale, it is difficult to tell. You can see it has gone up a little bit, but operational cash flow up and up and up, which is why we're seeing the free cash flow in green going higher. Shares outstanding. It looks like they have issued some shares and bought some back, but it's been consistently about this value here, so nothing really too interesting there. Now let's have a look at my discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. So initial price it is giving us is $123 a share, which is obviously less than the 180, paying a premium for these kind of stocks. Let's see if we look at the deeper numbers and agree with them. So we're expecting around about, based on the averages, 12% growth on revenue year over year, 52 and 59 billion. Let's have a look and see if analysts are agreeing with that statement. Bit more bullish actually, 52 and 60 billion. So we'll just bring that up to about 13%. We'll do 13.2 to bring it that price. $127 stock, up a little bit. Net income margins do look all over the place, actually, although it looks like the profit is down. So if we were to take an average of their more recent years, which is 32%, that would bring it up to $167 stock. And net income free cash flow, this number is really all over the place. Realistically, I think historically they would probably be close to this, which is about 150%. So this will unfortunately bring the price down back, interestingly, at that $128 a share. So discounted free cash flow model does not really like the stock. But you can see here with free cash flow ratios of 63, current free cash flow ratio of 63 and an average of the last 5 years of 80, you can see why this stock is not particularly liked. Before I continue, please give a like on the video if you haven't already, and subscribe, and check my Patreon if you're interested in the sheet. We'll quickly have a look at the dividend discount model. I think this will be all over the place, but with a current discount rate of around about, well, the current WACC is 4%, and if we put in the current average growth of the dividend, which is 12%, you can see it doesn't really like that. So if they would be a bit more less generous at 8, it puts it at $1,000 a share. The more I look at the dividend discount model for stocks, the less I like it. Basically, all you have to do is put in numbers that make it close to a price, and then it gets it. So if they had an expected growth of, say we brought the discount rate down to 8%, which is a bit more reasonable, and then the dividend, even if they grew at, say even 1%. So yeah, we'll skip past this. Before we get in the comparable company model, I'll just look at the Ben Graham formula for intrinsic value. this is created by Ben Graham himself. Looks at earnings per share, P of non-growth company, AAA corporate bond yield, currently 4.68%, sorry, currently. And let's see what analysts are saying for growth over the next 5 years. They are expecting around about 20%. So if you put in 20, $33 a share. Doesn't like it. This is because of the low earnings per share. So Ben Graham doesn't like this, but this is why we look at the comparable company model. This is a way of valuing companies, looking at similar companies of similar industries, similar market caps, and seeing if it is a buy or a sell compared to its competitors. So unfortunately, I would like to do TSM, which is Taiwan Semiconductor Manufacturing, as a sort of direct competitor, but unfortunately I can't currently because the sheet doesn't like things that are not in. And also the place I provided doesn't actually get the deals from there, so I couldn't do it anyway. But what we will look at is we will look at AMD. So I put in ticker AMD. It will give us all the values. Although interestingly, the Google price hasn't came up. God damn you, Google Finance. QCOM, which is Qualcomm. And that's in the price. Sorry, that is the chart. The price is there. Still interesting. It hasn't worked though. And finally, we'll do Texas Instruments. We did just look at them. TXN. So let's have a look at some of the metrics here. Enterprise value, Broadcom is considerably bigger than all these companies, 890 billion compared to 250 and 200. Revenue 46 compared to 23. Although QCOM is pretty high with 37. Revenue growth rate second highest, only AMD beats it with 28%. EBITDA 23. For 11.6. Net income, interestingly, not the most profitable, less profitable than Texas Instruments. If we look at the margins here, 10%, 5%, 23 and 33 for Texas Instruments. Price to sales, price to book, the current average of the market is around about 3 for price to sales, or higher than this. Qualcomm is the lowest, and then price to book 5 once again. Actually, AMD is lower than that. Next is the PEG, which is price to earnings growth, 1.23. Ideally, this is Peter Lynch's formula, and he prefers things under 1, or historically preferred things under 1. AMD, 0.4, very, very low, so that is quite interesting. Qualcomm next with 1.1, and then Broadcom 1.23. So now we look at the metrics here, EV to revenue, EV to EBITDA, PE, and forward PE. Now, these are pretty all over the place, actually, if you see it. Qualcomm and Texas Instruments a lot lower, 16.23 compared to 40 and 57 of AMD. PEs over the hundreds for Broadcom and AMD. Qualcomm and Texas Instruments a lot closer, 20, in fact lower than the market average, with 29, 21 and 34. Forward PE a lot lower again. So if we take some averages here, it does put it at about $125 stock. Now if I was to compare AMD and Nvidia and that was it, you can see it is, surprisingly not as good because of the, that's why. That was surprising. Unfortunately, I'm comparing it to 2 cruise companies because of my prior video. So obviously, it is going to be slightly overvalued to them. What I would have expected is that it would be about undervalued because of this. So yeah, that puts it about $200 a share, but still not massively a saving there. You can see that... we don't have the forward PE, unfortunately, here, but forward PE is a lot lower, 33.28. So, interestingly, maybe not a buy according to the comparable company model, probably slightly overvalued, but not too much. Ben Graham doesn't like the stock, and neither does the discounted free cash flow model. Right, guys, thanks for watching. Please check out my Patreon and like and subscribe and all that fun stuff, and I'll catch you guys next time.